Hello everyone, Scott here from Pillow Partners for this week's Lunch and Learn. I'm super excited about this one because it's a topic close to, or it should be close to every single short-term rental owner's heart, and that is capital allowances. I am here with two experts, Andrew and Tom, and I'm going to pass over to you guys to give an introduction to yourselves and the company. But capital allowance experts currently doing some stuff for our clients and various other tax-related things. So definitely experts in the industry. I would recommend them, and I wanted to get them on today to share some of the recent changes, guys, because we're very, very time limited to this now. We could maybe get this done in our own time when it suited us. But guys, we have a strategy for all of our hosts to make sure that they don't miss out. And I want to open that up to the wider audience. So I'll pass over to yourselves. Who wants to go first? Or are you just leading this, Tom?
Perfect. I'll jump in there very quickly because I'm not the expert. Tom's the expert here. So just on a partner level, that's why I'm here. But my name's Andrew. I'm one of the senior execs here. RCK, we're a financial consultancy that specialize in tax liabilities, specifically around R&D, capital allowances, and business rates. Today, we're here specifically to talk about capital allowances and why we have Tom, our resident expert, in here to join on that. And I'll hand that over to you now, Tom.
Yeah, perfect. Cheers, guys. So yeah, Tom Stenhouse. I'm part of the property tax team at RCK Partners. So I'm an associate on the team. And that property tax team is essentially built of RICS chartered surveyors, chartered tax advisors, and competent professionals in the field, sort of built on experience with capital allowances at some sort of larger firms. And whilst we probably started off as maybe more of a boutique tax incentive specialist, now we've scaled up quite a lot, and we're sort of knocking on the door of being one of the largest in the UK. So there's been great growth there, and that's testament to the team and our expertise and specialism in helping our clients mitigate some of their tax liability. So yeah, just to essentially give it a quick introduction to what capital allowances are. So they're essentially the largest or the main UK tax incentive for commercial property. So essentially what it's looking to do is incentivize UK tax-paying entities, whether that be a limited company, a partnership, a sole trader, to essentially invest in their commercial property to improve it, improve things like EPC ratings, and generally sort of rejuvenate UK commercial property scene, as it's quite outdated actually. And off that expenditure that's incurred, they essentially like to give tax breaks based on that. But HMRC never make these things straightforward and easy. So that's why you need a specialist like ourselves to come in, survey the property, survey your expenditure, break them down into the relevant qualifying pools, which is obviously quite technical and something that only we really need to look into to essentially alleviate any sort of tax liability you might have, increase losses if you are loss making for future periods, and generally get the largest ROI possible on that capital expenditure.
Fantastic. You'd mentioned a good point there, Tom. The government tax things that they can make money off, or they want to de-incentivize you doing, probably like smoking, but they incentivize you by tax breaks, and that's why this come about. They want to incentivize people. They want hosts to do this, and owners of, well, commercial, which would lead me into the next question. Many people say, well, residential property, you can't claim capital allowances because it's residential property, but the furnished holiday let, Tom, that falls into a different category for tax. So that's why service accommodation owners or furnished holiday let owners can claim that. That's definitely right, yes.
Exactly. So yeah, it's a really good point. So with capital allowances, as I said, it is only qualifying for commercial property in the UK, but there can be some sort of grey areas when we're looking for that definition and classification in property. So typically there are some serviced accommodation asset classes that are quite tricky. So I know this isn't particularly pertinent to sort of furnished holiday lets, but sort of build to rent schemes, large blocks of flats, essentially they are classed as commercial buildings, but the dwellings within them are residential and therefore don't qualify. So that's the sort of grey areas that we're talking about. So when we're looking at serviced accommodation, they do have their own sort of set of there's their own sort of set of tax legislation that falls around FHLs and capital allowances, which is really, really important to highlight. And it is essentially the difference between being able to claim and not be able to claim. And if I may just list out sort of there's 6 key criteria that we need to be able to qualify for a furnished holiday let or serviced accommodation to be able to essentially claim on capital allowances. So the first one we'd be looking at is the property being located in the UK or the European Economic Area. So that gives us a little bit of scope for properties that are held abroad, obviously, as long as they're part of a UK taxpaying entity. So the property has to be furnished, so we can't just have sort of a shell. It must be commercially let, so profits have to be intended to be made on it. The property has to be available for commercial letting as holiday accommodation for the public for at least 210 days in the relevant tax year, so a 12-month period. And out of those 210 days, it actually needs to be let out for 105 days or more as holiday accommodation. So it needs to be an active property in the market that is being let out. People are visiting and using it for a significant portion of the year. And then the final one is just around long-term occupation. I know this can sometimes rule properties out in serviced accommodation. So the long-term occupation, so let for 31 days or more to a member of the public, cannot exceed 155 days in one tax year. And any period of time where the property is let between 31 days and 155 days can't go towards that 105 days of allocation. So we need to be able to qualify those 6 criteria before we know that we have a claim to be made.
Perfect. And guys, if you are watching, if you are watching live, please ask some questions. Don't get caught up about the numbers here, about the 210 days advertised and the amount of times let and the time periods. That's why you have these experts here. So even us that are involved in these claims and helping our owners, Pillow as a management company literally just gives the evidence to these guys, and they do all the work. So don't get too caught up in the numbers, because I'm right in saying you can't do this yourself and submit this yourself. You are going to need a capital allowance surveyor and expert to do this.
Yeah. So Scott, so that's obviously part of our service, and when we come in, so there's no upfront fees for our service, so it's free consultation. So just to book in and have a chat with someone like myself or one of the team, there's absolutely no upfront fees. We just like to pick your brains, obviously ask these sorts of questions and look to qualify that, request relevant documentation, and we take all the burden off and make sure we're not taking up too much of your time to explore the opportunity. And once we know that there is a claim there, or there is a viable opportunity to look into a little bit further, then we look to obviously engage and go down that route of analysis and reporting. So really it's worth having the chat in the first instance. If you're not sure or you're intrigued by it and you think you might have a claim to be made, obviously just reach out and we'll do all the legwork there.
Fantastic. And your role is to survey the property, get that claim. That you're not replacing someone's accountant here. You will give that to their accountant, their family accountant, their business accountant, and they'll submit that to HMRC. You're another partner to assist them with their, let's say, power team.
Exactly, yeah. So we actually partner with a lot of accountancy firms. So they're actually one of our largest introducers for business, because they appreciate how specialist this area of tax is. And as it can be very lucrative for their clients, but often general accountants won't have the relevant training or expertise or time to dedicate to such a small area of accounting. So they often say, why would you get a GP to do heart surgery sort of thing? Yep. So we'll come in and do that really specialist deep dive and dedicate a lot of time and effort and resources to generate that sort of benefit for the client at the end of the day. But no, obviously accountants absolutely fantastic. The general accounting do 100,000 things that we couldn't do. But as I say, for these very specialist areas and tax incentives, R&D, capital allowances, business rates, and land remediation, accountants love to partner with us because we do a really good job there.
Perfect. Now, coming on to some numbers and percentages, because we hear this, and in big commercial units, you can get up to 45% of your purchase price back. And a lot of people just say, oh, well, you automatically get 45% of the purchase price back. But reality for, let's say, holiday cottages, serviced apartments, every case is different, but there isn't a definite number for that. Every case different.
Yeah. So again, this is why it's great just to have the conversation with us in the first instance, because I can ask some relevant questions about the property, about historical ownership, what might have been classified before you purchased it. Because obviously with serviced accommodation, holiday lets, a lot of these properties were previously classified as residential, but then people use them as investment properties to then let out as a holiday let and start a business off the back of it, or add it to a portfolio of properties that are generating revenue with intent for profits. So often with financial holiday lets, when we see an acquisition claim, they're quite promising, just because of that. If they were residential prior to them acquiring the property, no one could have claimed on them historically. So we could typically have an unrestricted claim there, which is obviously the most lucrative form of capital allowances on an acquisition. So yeah, we could look sort of between 35 and 45% qualifying off the purchase price, which is incredible. But then once you've acquired that property, any sort of refurbs that have gone in, so any property improvement works, if they're sort of adding maybe an extension on, or even just a ground up new development of a property with the intent to lease it out as a holiday let, with these sorts of investments and that sort of expenditure, we can claim anywhere between sort of 60 to 80% of that cost. So we look to qualify that, and from that pool of capital allowances qualified, say you're a limited company and you're profitable, you'll be paying a 25% corporation tax rate. We look to get you that back in benefit. So that's how it's received.
Perfect. And I'll follow on that just to ask you a clarifying question there, because we get asked all the time from hosts, well, if I've got a £50,000 claim, is that 50 grand into their bank account, or is that put off to the next tax year as a tax-free allowance?
Again, so it is purely context dependent. So with each client it's different, and it depends what their financial position is when the expenditure was incurred within their accounts. So there are actually situations where you can get cash back in your pocket in the form of a tax rebate. So if we're looking at expenditure that was incurred a couple of years ago, and you've already paid your tax bill, but we're leveraging that expenditure for capital allowances, it hasn't been claimed on, which is quite typical, then that corporation tax paid, or that personal tax that you've paid to the revenue, we can look to claw that back and you'll get a cash rebate. However, if we're looking at it in the sort of current period, or you don't have any tax liability to offset, then we're looking at either reducing that immediate tax liability, so you can just factor that out of your cash flow projections, so you don't need to pay that now to the revenue, which is obviously fantastic. So that's money saved back in your pocket that you knew you were going to have to outlay. Or it will be losses carried forward, so you'll be able to project for future periods when you are turning a profit. You'll have those losses in your back pocket to offset that, and you'll be able to essentially utilize that profit and not have to siphon off the percentage to HMRC. So it's a very lucrative asset and can be very, very helpful for your cash flow projections, your financial forecasting, but also you can get a nice bit of cash in your back pocket in some instances too.
It was amazing, and one of the very first times I ever heard about capital allowances many years ago, and I was listening, and one of my first mentors, he was telling a story of how it was an SPV, his limited company, had made £1 million in income, and he showed that he made £1 million in income, but got a tax rebate from the HMRC for £60,000. And I couldn't get my head around that, because as business owners, especially for landlords and furnished holiday owners, we pay tax. But he had structured his business so, and again, he did a lot of commercial property. It wasn't just furnished holiday lets; it was all commercial as well. But he earned £1 million in one tax year and get sent a cheque for £60,000, and that's when it really struck me the the powerful nature of capital allowances. Now, your average person with one holiday home won't be able to be offsetting £1 million worth of income and get the rebate, but there are no negatives to any landlord doing this that owns short-term rental accommodation, is there, Tom? There just can't be any negatives to this. It's all positive.
No, not at all. So as I said, to explore the opportunity is completely free of charge. There are no hidden costs or upfront fees whatsoever. So to just inquire and look into it, there is genuinely no risk whatsoever in looking into it. So the way that we charge our fees are on a fully contingent basis. So we only charge a percentage of your final tax saving, and we only, as I say, only charge for that once you've received that benefit. So you're always winning. Either there isn't a job to be done, unfortunately, or you're achieving an additional tax saving at the end before you outlay any cost. So there really is no risk looking into it. In terms of risk with compliance in HMRC, at RCK, we've got the largest compliance function in the tax incentives industry. So we have ex-HMRC inspectors that were essentially vetting these claims as part of the revenue that we're able to bring across to our in-house team, and they vet every single report that goes through the business. As you can imagine, we deal with HMRC on literally an hourly basis, and our reputation and relationship with them is of the utmost importance. So we want to make sure that we're doing everything in our power to be as compliant and robust in our reporting as possible. And off the back of that, the clients are getting a gold standard of compliance in their reporting and in the claims they'd be submitting. And they also have the peace of mind that they don't need to worry about any sort of issues coming back from HMRC. That being said, we also do have obviously free inquiry defence. So our compliance team again will defend any claim that HMRC did look to question. Not that it's ever actually happened for capital allowances, but fingers crossed it stays that way.
Fantastic. Listen, there's a very, very few things in life that have kind of ultimate upside and no downside. The capital allowances is definitely one of them. When it comes to a property, you can only claim it once per property. Is that right?
Yes. So you can only leverage the expenditure once, and this is the slight issue with the acquisition claims. Is if it was classed as serviced accommodation or an FHL prior to them acquiring the property, and it had already been claimed by the previous owner, then sometimes we'll have cases where they don't have entitlement, as you can't double claim it. That's why one of the more lucrative ways of claiming, or one of the quicker benefits, is if they've incurred capital expenditure refurbishing or developing the property, because it's there, they've spent the money, and we know that they can have entitlement to it essentially.
I'll go back to the previous story, and one of the reasons I'm bringing that back up is the building that he claimed capital allowances on was actually an old accountant's office, and I forget the numbers, but they were in their own office for 20 to 25 years. They owned that block of properties in Doncaster. MD that's been to Doncaster for training will know who I'm talking about. I won't share it publicly, but that was a commercial unit with 5 flats above. The accountants owned that building for 25 years and didn't submit a capital allowance claim. And that property investor bought it and then redeveloped it and turned it into serviced accommodation when it was buy-to-lets, redeveloped the commercial unit from being an accountant's office to sublet it back out. But that was amazing that not all accountants know this. So you guys are specialists. That imagine an accountant being in a building for 25 years and not claiming capital allowances.
Yes, Scott, it's absolutely unbelievable, to be honest. Obviously, we're doing this every single day, and the amount of people that I speak to that have been in the property investment game for multiple decades and are so well respected, have so much skin in the game, and are doing fantastically well, are generating massive profits, and they've never heard about capital allowances or looked into it or had a specialist come in and do essentially a full report of their property portfolio to leverage their expenditure over the years. And one of the beautiful things is we can look back indefinitely. So there's actually no time limit applicable for capital allowances that we can't look back any further than. So we've got really broad scope over all of your property investments as long as you still retain the freehold to them, or you've got an extremely long leasehold. we've got scope to look back on it. And it's unbelievable the sort of benefits that we can achieve. Obviously, you've mentioned an incredibly lucrative one there, but we've had clients where we've managed to get them £4 million back off their tax liability, of that maybe £1 million in cash. Obviously, these are really big time investors with long-standing portfolios, but the benefit really is incredible in some instances. It's definitely a lot more of an education piece, and something that people just need to explore and give it a punt really, and have a chat with us, because until you do that, you'll never know.
Definitely. And again, I'm not qualified to be giving financial advice or anything. I know I was asked there, what do you know about capital? Slightly above average, slightly above average knowledge about capital allowances, but I always pass it on to our hosts and pass it on to you guys. But we deal with some big developers as well, and these are guys with tens of millions of pounds developments. Didn't know about capital allowances, and a very quick back of the fag packet. It's like that one conversation. I like to call them £50,000 conversations. Every capital allowance thing I talk about, £50,000 conversation. But this one was this was a £1 million conversation with a developer, and these guys had been in the industry for 20 years, had like gross development values in the hundreds of millions of pounds, and had never claimed capital allowances, and we could operate them as furnished holiday lets when they were just going to renovate them and flip them, and it would have been residential. But a quick change of your business model, literally saving people millions, and that very quick 10-minute conversation, the guy's mind was blown. He's like, Scott, I think you've just literally made me £1 million. That's it, the big numbers we're talking. But again, not everybody has. There's somebody saying, just great chat about to consider doing my first service accommodation. Tracy, yes, if you're changing that from buy to let and doing service accommodation, it qualifies. HMRC changes the criteria. Again, not giving financial advice, I'll ask these guys, but if we're changing buy to lets, Tom, to furnished holiday lets, operating it for the time periods that we need to qualify, we can take the same property that historically has been a buy to let, operate it as furnished holiday lets, and it now qualifies. Is that right?
Yeah, 100%. So if you're looking to reclassify an asset and turn it into service accommodation or a holiday let, then 100% is something that we can look into for you, as it should qualify now. The only things that we will need to look at, and it's obviously part of the conversation, the consultancy in the first instance, is what sort of your plans are for it moving forward, and how you're going to be letting it out, and the sort of timescales surrounding that, essentially. But definitely something to be aware of and look into, if you are looking to enter that market, and look to start a business in serviced accommodation for sure.
And to the viewers, Tom mentioned this very briefly at the start. Again, one thing we're always aware of, you may be operating your property as short term as a furnished holiday let, taking guests under 31 days. But remember, if you're taking longer corporate guests, it starts to get a little bit complicated, and it's not going to go into it here with you, Tom. But if you're doing short term, the Airbnb market, but once you start doing longer term, again, a lot of things we do, going out to insurance companies, corporate lets, long term things, putting sports teams and movie stars and bankers and doctors into properties for years. Those periods, and not to complicate it, because we don't want to talk about the numbers too much, because it's very complicated and we shouldn't be making. You speak to these guys, give them your details, look into it in depth. So I don't want to get caught up into the numbers, but guys, we need to be very careful, that we may be operating that as short term and we think it qualifies for capital allowances, but actually that qualifying period of that tax year won't, because you're doing longer term lets. So I'm right in saying that, Tom. We need to be very careful. You need to work with your managing agent to make sure that your strategy for filling your units is right. You need to work with these guys to make sure that all your evidence is there for claims.
Yeah, exactly. We need that documentation, essentially, to outline the amount of time that's been let out, the amount of time it's been available to be let out, which is obviously very straightforward to gather, just so we can make sure that we're working obviously within the relevant capital allowances tax law, and make sure that we are qualifying these assets properly for the tax relief and the benefit that's very generously there for them. So very important to make sure that we're doing that. And as you said, with those long-term service accommodation assets, whilst if you were, for example, having someone or a company in that property for maybe 2 to 3 months of the year, there still is great scope, because we can then go and look at the rest of the year and see what you did there. But if, say, you had a company in there for the whole year, I don't know, you're putting up a film production team for a whole year in one site, then it's worth having a conversation around whether we're qualifying or not. But in that situation, potentially not. So definitely worth speaking to us, so we can make sure that's crystal clear and we're being fully compliant.
Yeah, and we've had properties that are doing very, very successfully in long-term lets, corporates, and the team at Pillow Partners HQ literally have long-term lets ready to put in. But we know from working with you guys as well that, listen, we need to change that to a shorter-term strategy and do that for a few years, qualify, and then we'll reassess the business model further down the line. But and put some properties that they've already claimed capital allowances, we can switch all the corporate guests to those, because that doesn't matter. That's a different strategy, and work. So you need to work with your managing agent to make sure that you're getting these things slotted in. You said take advantage of the tax incentives that are generously offered. Did I hear something in the last budget, Tom, that may be changing that and not generously offering it just as much anymore? Okay, if you cover that, I think that'll be the most important part, making sure people don't miss out on this.
Yeah, so this is really, really key, and it's something that was brought in the spring budget by Jeremy Hunt, and I'm sure that a lot of people, obviously listening to this, will be well aware of it. Was the abolition of the concept of FHLs. So that is no longer going to exist from April next year, and therefore this capital allowances offering that qualifies FHL service accommodation will no longer be available. So we have a finite time now in the next year to make sure that we're leveraging any expenditure within this next year and anything historically, to make sure that we're essentially achieving the benefit while it's still available, and leveraging that tax incentive before it goes away, unfortunately, for this specific asset class. So time is of the essence, and that's why I'd heavily encourage anyone that is interested or has spent significant amounts of money on their portfolio in serviced accommodation, furnished lets, or a wider portfolio of commercial property, to get in touch essentially ASAP. And make sure that you're covered and you're making the most of it while you still can.
So the good thing here, guys, is that we're not. It may be withdrawn. That's fine, but there's still time for pretty much every host to do this. Fantastic, guys. We would normally be sharing presentations here. We would normally share contact details. I'm in the streaming software as we're going live, but anybody that's interested in this, just so you don't need to submit your public details for everybody to see, email hosts@pillowpartners.co.uk and we will introduce you. So we're working with the RCK guys, and Andrew, we're doing some stuff together. Quickly, we said we'd focus on capital allowances, but you guys do other things as well, don't you? Because you're helping us with a few things too.
Yeah, that's right. So we cover off a variety of areas. It's mainly focused on the tax liabilities space. So I sit within the R&D team. Tom's obviously in the property tax. So R&D is specific to any scientific or technical advancement within their field or industry respective. So we work a lot with the construction side as well. So very relevant on that side with the capital allowances and the crossover there. So if anybody's doing any development and finds there's a headache of actually doing anything within their properties or their FHLs, we can actually look into that and see whether there's some R&D that's claimable there. This could go down to the construction companies, but it could be eligible for the owners as well at that point, depending on who makes a claim in there. We cover off other areas as IP and gaming as well on those tax liabilities as well, but specifically, R&D for that. And I believe, we're supporting a lot of our clients doing that and growing exponentially. Something that we can obviously help and support with the fact that we've got the compliance and consultant team that are so rigorous in our industries. So their respective fields such as technology, biomedical. You've got obviously the tax guys and the RICS as well. So you've got it from every perspective that they come from. So it's not just a vocational perspective and industry knowledge. It's actually an academic position as well for them. So Yeah, happy with that. And our compliance team, obviously, as Tom rightly said, ex-HMRC. So we have that angle to understand it and to be able to maximize the returns that you guys get to as much as possible by leveraging certain areas where we understand.
Fantastic. Super. So last question here. There is a deadline. We need to get things doing with people that say, well, we'll get round to this. What are the timescales? Because if they're withdrawing this, what's some timescales? If I'm encouraging everybody to email hosts@pillowpartners.co.uk, we pass you these leads. And guys, if you are watching, like Tom says, there's no obligations, there's no fees or anything. And we just want to share this. We are sharing this with all our hosts to make sure every single customer of Pillow takes advantage of this. Guys, it's there. Don't lose it. But for anybody watching, we're extending that. Email us at hosts@pillowpartners.co.uk. We'll share that on with the guys. They will get in touch. What's the time scales that to get in touch with you guys, to do the analysis, to get the evidence, submit a claim?
So to be completely honest, I think so it'll be early April of next year where you'll sort of lose any eligibility to claim this. Yeah. So ideally, we'd want to look at it this calendar year, just to make sure that we've got plenty of time, plenty of backstop to get those claims and reports finalised and submitted to the revenue prior to that deadline. So that's really key, is to get in contact with us as early as possible. So we have plenty of time to essentially look into this for you. With that in mind, though, if, for example, you're looking to acquire a property in the next sort of 6 to 9 months, or you're looking to undertake extensive refurbishment works, or you're about to complete on a new development, whatever it might be, obviously we need that expenditure to be incurred, and that money to have actually been paid to be able to leverage it. So if in the next 6 to 9 months you are looking to do that, and that's just about to happen, or it's going to happen within that period, as soon as it's done, reach out to us and we'll get that turned around for you as soon as possible. We've got a great team internally with some really, really intelligent, highly qualified individuals that work very, very hard to make sure that we get these reports out to the highest quality. If there's a short turnaround and a short-term deadline, we're more than happy to do that for you.
Good. Now, for any of our hosts watching, you should have been contacted. We've moved this forward. We've done specialist training. The guys here have done specialist webinars. We've trained all our team up on this to speak to our hosts. So if you're a customer of Pillow, you will be sorted for this, and we will not let you lose. And initially, we're just going to re-encourage people to do it and make this a closed webinar, but just decided to go live, just because it's been withdrawn. And listen, it's a tax incentive, and landlords, holiday home owners, we sometimes get the bad side of it with licensing coming in, with withdrawing of the mortgage interest and the previous Section 24. Lots of changes here, guys. So I want to make sure everybody in our industry takes advantage of this. So anybody that's emails over hosts, guys, we'll just put you direct in touch with these guys, and they will make sure your claim is in. Any final thoughts or comments, Andrew or Tom, before we finish up?
So yeah, one thing from me really, and this is something that is definitely adds even more sort of incentive to it, or more sort of focus to it, is if you have incurred expenditure in the last 2 to 3 years, so within your open accounting periods currently, that is the most lucrative time that you can claim on capital allowances. So you will be getting a large percentage of that, if not all of that, up front off your tax liability straight away, which obviously generates the largest results. And then anything outside of those open accounting periods is something called written down. So it's I guess like a slower rate of relief. You still do receive the full tax benefit, but it's maybe not as quick realized. So I think anyone that's incurred expenditure, acquired a property, expanded the portfolio in the last 2 to 3 years, and you haven't had this looked at, that really is another key driving force behind looking into it as soon as possible, maybe before your upcoming financial year end as a limited company. I don't know if it's in June, then you've really got to act quickly, or July over summer. So that's an additional incentive there to make sure you're getting as much tax relief upfront, and that's the best way you can do it. That's the most efficient way you can do it.
Super. Well, these guys here at CK are doing it for free. We're doing it for our hosts. There'll be many companies out there, I'm sure, that would charge you for this. and be saying, well, you need to get in before the deadline and we'll fast track your process, or you're going to miss out if you don't pay some money up front. But we've made sure any watchers, any viewers of the podcast can get this for free. So there's absolutely no reason you don't reach out to these guys. I can only say, well, it's been claimed before or you're not eligible, but it is only a win-win situation here, guys. So we use them. I can definitely recommend the professionalism behind the scenes, chasing me, making sure I'm submitting all the evidence for our due diligence team. So they're relentless pushing me. Admin is not my strong point, as Andrew will tell you, following up on stuff that's paperwork, even though there's big sums of money involved. So the guys are professionals behind the scenes, so they definitely get my vote of confidence. It's the only reason we would open our host network up to any company to help. So thank you guys for your time today. Any leads that come in, we will forward straight over to you, and you guys are happy to answer any questions. There is just no reason not to reach out and see if your property is suitable. So little lunch and learn here, guys. We'd like to get it done nice and early, finish up within the half an hour to let people get this done in their lunch break. That's why we've timed it. If you have been watching on the replay after the fact, watching it on the YouTube or social media or on the newsletter, and you didn't get your questions answered, just reply, let us know, and we will pass your queries over. Andrew, Tom, thank you for your time. Everyone, have a fantastic day, and I hope you've learned something. I know I definitely did. Cheers, guys.